Imagine losing your home, your saving, your job, and your dignity in a matter of months. This is not a dystopian fiction. This is the reality that Peter Schiff, a famous American stockbroker and financial commentator, predicts will happen soon due to the rise mortgage crisis. In this video, we will explain why he thinks the housing market is in a bubble that will burst soon, what factors are causing it, what the consequences will be, and what you can do to protect yourself from it. Before we dive into the details, let me give you some background information on how the mortgage market works and why it is so important for the economy. A mortgage is a loan a person or a business takes to buy a property such as a house or an apartment. The borrower agrees to repay the loan with interest, usually 15 or 30 years. The lender, a bank, or another financial institution holds the property as collateral until the loan is fully repaid. If the borrower fails to make the repayment, the lender can seize the property and sell it to recover this money. This is called foreclosure. The mortgage market affects the borrowers and the lenders directly involved, and many other players indirectly connected to it. The mortgage market also affects the overall economy and the society in many ways. As you can see, the mortgage market is very complex and interconnected with many other aspects of the economy and society. Therefore, any changes or disruptions in this market can have significant ripple effects across various sectors and regions. Now that you have a basic understanding of how the mortgage market works and why it matters so much for everyone's life quality, let's see why Peter Schiff thinks that this market is in trouble and what sign indicates that he may be right. One of Schiff's main arguments is that the current housing boom is artificial and unsustainable because it is driven by factors that are not related to real supply and demand, but rather to government intervention and manipulation. He claims that the Federal Reserve, which is the central bank of the US, has been artificially suppressing interest rates for too long, creating a false sense of affordability, encouraging excessive borrowing and spending. He also claims that the government has artificially stimulated demand by borrowing various subsidies and incentives for home buyers, such as a tax credit, down payment assistance, mortgage forbearance, eviction moratorium, etc. He also claims that the government has artificially inflated supply by bailing out failing banks and mortgage lenders, buying up toxic assets, and guaranteeing loans that would otherwise be too risky or unprofitable. Schiff argues that the policies have distorted the market signals and created a moral hazard problem, where people act irresponsibly because they expect to be rescued by the government if things go wrong. He says that these policies have created a bubble in the housing market where prices are detached from reality and fundamentals, and where people buy homes not because they need them or can afford them, but because they expect to sell them for a higher price in the future or to use them as ATMs to access cheap credits. He says that these policies have also created a debt bubble in the mortgage market where people take on more debt than they can handle and where lenders relax their standards and offers loans to people who are not credit-worthy or who have no income or assets to back them up. Schiff warned these bubbles will burst sooner or later, as they always do in history. He says that when interest rates inevitably rise, either because the Fed decided to tighten its monetary policies or because the market forces it to do so due to inflation or loss of confidence, many borrowers will be unable to make payments or refinance their loans. He says that when supply increases due to more foreclosure, more difficulties, or more distressed sales, many homeowners will find themselves underwater on their mortgages, meaning they owe more than their homes are worth. He says that when these factors converge, they will create a various cycle of falling prices, rising defaults, shrinking credit, and contracting economic activity. These are some shocking effects of Schiff's expects from the rising mortgage crisis. But how likely is this scenario to happen? And what are some of the evidence that supports his claim? Let's look at some of the latest data and news that shows how serious the situation is. According to Black Knight, a leading provider of data and analytics for the mortgage industry, as of July 2023, there were about 3.5 million mortgages in forbearance, meaning that the borrowers were allowed to temporarily stop or reduce their payments due to financial hardship caused by the pandemic. There's about 6.5% of all mortgages outstanding representing about $700 billion in unpaid principal. According to Realty Track, a leading source of information on foreclosure activity as of August 2023, there were about 1.2 million properties with foreclosure filings, meaning they were in some stage of default, auction, or bank ownership. That's about 0.9% of all housing units, representing an increase of 60% from a year ago. These indicators shows that the mortgage market is under stress and that housing bubble is close to popping. Of course, not everyone agrees with Schiff's analysis and predictions. Some people argue that the housing market is still strong and resilient, and that the current situation differs from 2008. They point out that the borrowers today have higher credit scores, lower debt-to-income ratios, and more equity in their homes than the borrowers in 2008. They also point out that the lenders today have stricter underwriting standards, more capital reserve, and more regulatory oversight than the lender in 2008. They also point out that the government today has more tools and resources to support the housing market and prevent a systematic collapse than the government in 2008. However, Schiff counters this argument by saying that they are based on false assumption and wishful thinking. He says that the borrowers today are not as creditworthy as they appear because they have relied on government stimulus, forbearance, and moratoriums to mask their financial situation. He says the lenders today are not as prudent as they appear because they have relied on government guarantees, bailouts, and subsidies to make risky or unprofitable loans. He says today's government is not as powerful as it appears because it has already exhausted its fiscal and monetary ammunition and faces a credibility crisis as the debts and deficit spiral out of control. Schiff believes that the only way to avoid or mitigate the mortgage crisis is to let the market correct itself naturally, without any interference or manipulation from the government. He says that this would allow the prices to fall to their fair value, the debt to be liquidated or restructured, and the resources to be reallocated efficiently. He says this would allow the economy to heal and recover from its imbalance and distortions. He says this would be painful in the short term, but beneficial in the long term. Schiff also advises people to take action to protect themselves from the mortgage crisis and its consequences. He says people should sell their homes if they can, or at least reduce their debt and increase their savings. He says that people should diversify their assets and income resources and avoid holding too much cash or dollar-denominated securities. He says that people should invest in real assets and commodities such as gold, silver, land, or foreign currencies. He says people should also prepare for social and political unrest and safeguard their rights and freedom. This is what Peter Schiff thinks about the rising mortgage crisis and its shocking effect. Whether you agree with him or not, we hope you found this video informative and interesting. If you did, please give it a thumbs up, share it with your friends, and subscribe to our channel for more videos like this one. And don't forget to hit the bell icon to get notified when we upload new videos. Thank you for watching, and we will see you next time.